The era of easy returns is over. Not maybe, not someday, over. In 2026, we could see something most retail investors aren't prepared for. A market where returns go sideways for years. Or worse, a sudden 30% reset. Here's the uncomfortable truth. The S&P 500 has delivered double-digit returns largely driven by multiple expansion, not earnings growth. That's like a house going up in value, not because the rent increased, but because buyers got emotional. And emotion eventually meets math. Right now, valuations are stretched, debt levels are elevated, liquidity is tightening globally, and when liquidity disappears, markets don't correct. They drop. Liquidity is like oxygen. You don't notice it until it's gone. Today, we're breaking down 5 indicators that historically flash warning signals before major downturns. Not fear, not clickbait, data. Because crashes don't start when headlines panic. They start when smart money quietly repositions. The problem/opportunity. Let's frame 2026. The Federal Reserve stabilizes rates around 4.5%. Inflation cools but doesn't disappear. Infrastructure spending remains elevated. Government debt continues climbing. Meanwhile, capital is rotating. Institutions are shifting toward short-duration bonds, real-world assets, private credit, energy infrastructure. Retail? Still buying mega-cap tech at 30x earnings because it worked in 2021. That's the wealth gap. The top 1% doesn't panic sell. They rotate early. And here's the key. Crashes rarely come from nowhere. They leak. Through credit markets, through valuations, through liquidity tightening. So let's break down the first and arguably most important indicator. The Buffett indicator is flashing red. The Buffett indicator measures total U.S. stock market capitalization relative to GDP. Warren Buffett has called it probably the best single measure of where valuations stand. Historically, 2000 dot-com peak 140%, 2008 pre-financial crisis 110%, long-term historical average 80-90%. In 2025, we're sitting around 170 to 190%. That means the stock market is nearly double the size of the U.S. economy. That's not growth. That's pricing future perfection. And markets don't reward perfection for long. Why this matters? When a market cap grows faster than GDP, one of 2 things must happen. Earnings surge dramatically. Prices fall to rebalance. Right now, earnings growth is slowing. Forward P/E on the S&P 500 is hovering around 23x. That's historically expensive, especially with rates at 4.5%. Higher rates compress valuations because investors demand higher returns to justify equity risk. Simple math. If Treasury yields are 4.5% and stocks yield 1.4% dividends with 6% growth assumptions, the risk premium narrows. And when risk premiums shrink, corrections expand. The $1,000 growth model valuation reality check. Let's say you invest $1,000 in the S&P 500 at 23x earnings. If multiples compress to the historical average of 17x, without earnings falling, that's roughly a 25 to 30% price contraction. Your $1,000 becomes $700. No recession required. Just reversion to mean. That's how dangerous valuation compression is. It doesn't need panic. It just needs gravity. But here's the tweeze. Valuation alone doesn't crash markets. It creates vulnerability. The trigger comes from somewhere else. And historically, that somewhere else comes from credit, which brings us to indicator number 2. Because if equity markets are priced for perfection, credit markets are priced for stress. And credit cracks before stocks do. Credit spreads are quietly widening. Equity investors watch stock charts. Smart money watches credit, because credit markets break first. Here's what matters. The spread between U.S. Treasuries and high-yield corporate bonds measures perceived default risk. When spreads are tight, investors feel safe. When spreads widen, risk is rising. Before, 2000 crash spreads widened months before equities collapsed. 2008 crisis credit markets froze before stocks imploded. 2020 COVID crash spreads exploded before the bottom. In 2025 to 2026, we're seeing early stage widening again. Not panic levels, but movement. And movement in credit is like tremors before an earthquake. Why this is dangerous now? Corporate debt levels are near historical highs relative to GDP. Companies borrowed aggressively during the zero-rate era. Now, they must refinance at 4.5 to 6%. That changes everything. Higher refinancing costs, lower free cash flow, lower buybacks, lower earnings support. And remember, buybacks have been one of the biggest drivers of stock price growth over the last decade. If buybacks slow, artificial demand disappears. The $1,000 stress test model. Let's say you invest $1,000 in a high-yield bond ETF like HYG, iShares iBox High Yield Corporate Bond ETF, J&K, SPDR Bloomberg High Yield Bond ETF. If spreads widen from 350 basis points to 600 basis points, similar to mild recession conditions, these ETFs could drop 10 to 15%. Your $1,000 becomes $850 to $900 quickly. Now, imagine that stress spilling into equities. That's how dominoes fall. But here's the problem. Credit stress doesn't always cause crashes. Sometimes it stabilizes. So, what's the next layer? Liquidity. Liquidity is quietly contracting. Liquidity is the fuel of markets. From 2020 to 2021, the Federal Reserve injected trillions. Quantitative easing, zero rates, stimulus. That liquidity pushed asset prices up across everything. Now, quantitative tightening, balance sheet reduction, higher cost of capital. When central bank liquidity contracts, asset prices face headwinds. Always, not immediately, but eventually. Here's why. Markets trade on marginal buyers. If liquidity shrinks, fewer marginal buyers exist. That creates lower volume, higher volatility, sharper downside moves. Liquidity doesn't evaporate evenly. It disappears from the weakest assets first. Speculative tech, unprofitable growth, high leverage plays, then it spreads. Advanced metric, M2 money supply, M2 growth has slowed dramatically compared to 2020 stimulus peaks. Historically, when money supply growth turns negative year over year, markets struggle because fewer dollars are chasing assets. It's simple supply and demand. Fewer dollars, same assets, lower prices, the bridge. But liquidity contraction alone doesn't cause a crash. It creates fragility. The real trigger often comes from macro pressure, and that pressure shows up in one place almost every time: the yield curve. The yield curve is still sending signals. When short-term rates exceed long-term rates, the yield curve inverts. That inversion has preceded every major recession in modern U.S. history. Every single one. The curve inverted aggressively in 2022 to 2023. Now it's steepening again. And here's the nuance most people miss. Markets often crash after the curve starts normalizing, not during inversion. Why? Because normalization usually means the Fed is cutting rates. And the Fed cuts rates because something broke. That something could be corporate defaults, commercial real estate collapse, regional banking stress, geopolitical escalation. The curve is not a timing tool. It's a warning system. The $1,000 defensive allocation model. Let's compare two scenarios. Scenario A, fully in S&P 500 at peak valuation. Scenario B, 60% equities, 40% short duration treasuries like SHI or SGOV. If a 25% correction hits, scenario A, $1,000, $750. Scenario B, $1,000 approximate $880 to $900. That difference compounds massively over time. Crash survival isn't about prediction. It's about positioning. The cliffhanger we've covered. Valuation excess. credit stress, liquidity contraction, yield curve signals. But none of those alone guarantees a crash. There's one more indicator, the one that turns fragility into freefall. And it's happening in plain sight. Earnings revisions are rolling over. Markets run on expectations, not headlines, not vibes, not CNBC panels. Expectations. And right now, forward earnings revisions are quietly trending down. Here's how this works. Analysts project future earnings. Stock prices discount those projections. If projected earnings drop, but stock prices don't, valuations expand artificially. That creates air pockets. Historically, before 2000 crash earnings revisions turned negative 9 months prior. 2008 crisis revisions deteriorated steadily before collapse. 2022 correction forward EPS estimates fell sharply before the drop. Now in 2026, we're seeing slower revenue growth, margin compression from higher labor costs, higher refinancing expenses, reduced buyback support. That combination is dangerous because if earnings flatten while valuations remain elevated, multiple compression becomes unavoidable, and markets hate recalibration. The math nobody talks about. Let's assume S&P 500 trading at 22x forward earnings. Projected EPS equals $250. Fair value at historical 17x multiple? $4,250. If current index level implies 22x, that's around $5,500. That's a potential 20 to 25% downside from multiple normalization alone. No catastrophe required, just gravity. So, is a 2026 crash guaranteed? No, but vulnerability is elevated. Let's zoom out. We have elevated valuations, rising credit stress, a liquidity contraction, yield curve normalization, weakening earnings revisions. Individually, manageable. Together, fragile. Markets don't crash because of one problem. They crash because multiple weak points align, like pressure building behind a dam, risk management, and 2026 outlook. Now here's the part most YouTube videos skip. If risk is rising, what do you actually do? Not panic sell, not hoard cash. You build margin of safety. What is margin of safety in 2026? It means owning companies with strong free cash flow, low debt-to-equity ratios, pricing power, defensive cash positions. For example, instead of speculative growth trading at 40x earnings, look at energy infrastructure ETFs like XLE, defense contractors with backlog visibility, utilities with regulated cash flow, short-duration treasury ETFs like SGOV. Margin of safety is about survivability, because in crashes, liquidity matters more than growth narratives. Black swan risks that could accelerate a crash, geopolitical escalation disrupting supply chains, commercial real estate defaults triggering regional bank stress, sovereign debt scare, U.S. debt to GDP continues rising, unexpected inflation resurgence forcing rates higher again. Remember, the Fed at 4.5% doesn't have the same room to cut as 2020. Policy ammunition is limited. That's important because past crashes were softened by aggressive stimulus. 2026 may not have that luxury. Conclusion: 3 non-obvious takeaways. Let's simplify this. Keycap 1 crashes begin in credit, not stocks. If high-yield spreads spike, pay attention immediately. Keycap 2 valuation compression doesn't need recession. Even flat earnings can produce a 20% drop. Keycap 3 liquidity drives everything. When central bank balance sheets shrink, volatility expands. Final thought: this isn't about predicting doom. It's about recognizing fragility. Because the biggest mistake investors make isn't missing bull markets. It's being overexposed at cycle peaks. And 2026 looks more like late cycle than early cycle. Direct hit action step. Open your portfolio tonight. Ask yourself, if the market drops 25%, am I positioned to survive or to panic? Then, rebalance. stress test allocations, track credit spreads weekly, and if you want my full 2026 macro dashboard and allocation model, check the portfolio tracker linked in the description. Now, I want to hear from you. Do you think 2026 brings a controlled correction or something much bigger? Drop your thesis in the comments. Because smart investing starts with thinking independently, not reacting emotionally. And in markets like this, discipline beats optimism every time.